Well, good morning. Thank you for joining us yet again in our series under the Resilience Innovation Investor Forum. I'm Richard Seeline with the Resilience Innovation Hub and one of your co-hosts and founders. I think it's frankly a lot of information to share this morning, so I don't want to overtax my time. I really want to get to the great panel, but I just also want to share a little bit of the background on what the forum is about, what we are intending to do with all of this great brain power and knowledge, and how it connects to this future-proofing America goal that we have. You can read faster than I can, but the intent of going from what was going to be, Lars, as you may recall, a 2-day in-person event in February. No, did I mention that, Lars? It was supposed to be October, November, December, then January, then February. So hopefully we're past the curve now, at least to some degree of COVID, and we'll be able to go back in person as planned in April, May, and June. But for the purposes of doing this in a virtual setting, we thought this was a great way of connecting founders, innovators, and investors, and really looking at what the immediate opportunities are around these issues of disaster and risk mitigation. And, Lars, for the purposes of working with Michel and Scott, this idea of defining risk at a level into communities could only be, more important these days due to all of these issues that we now recognize are truly driven by, the excess of these types of persistent disasters. And I don't need to remind the three of y'all, you study it every day, 24/7, but we've had these billion-dollar back-to-back and somewhat overlapping series of events from 2017 forward, if not before. And that now complicates the reality of lots of data that is collected just on one, incident, one weather event, one disaster, one peril. Now we've got them overlapping, and that's creating, frankly, some complexity at the local and community level on how to assess where risk mitigation strategies will emerge. It's not without resource drivers to this. We know that the White House, Congress, the private sector, the academic sector are all aligning that we need to do something different than what we've done in the past, and how we apply insurance as an economic capital value proposition is something that you all have taught me, and I'm sure we'll discuss today. But I come to this point, Lars, that it really isn't a resource issue. We have abundant amount of resources, except it's fragmented, disconnected, it's competitive, and it's not aligning. The amount of money that is on the table, whether it's the $1 trillion, Scott, that Frank Nutter testified about last July and at a Senate House Joint Committee, whether it's the $550 billion already appropriated. This doesn't count the $1 trillion of the infrastructure bill. This is the other $550 billion. And Lars, again, as you and I have talked about, this includes the unspent presidential declaration money that's still around the country. And then last but not least is the $12+ trillion of generational wealth that's now going into impact funds and family offices, as we heard from Howard Buffett and others. So we have abundant resources. They're fragmented, sometimes difficult to get a hold of. That then led to this idea of this resilience data exchange and this concept that we are drowning in data and thirsty for intelligence. And so part of what I would like to put on the table as a call to action from this session, Lars, Michel, and Scott, is how do we now really start connecting even further the work that you're doing to others out in the communities in three ways. One is how do we, address the sharing of critical data across sectors and sources. Second, how do we look at this whole issue of cost benefit, return on investment, meaning the dollars that are available. And I probably shouldn't have limited this just to the issues on the federal side. It's the same thing that we're finding on the traditional investment arena, whether it's the mortgage bankers reports or the S&P Moody's reports. And then last but not least is how do we increase the knowledge sharing to have true impact on the low to moderate income communities? So Lars, nothing like a bunch of great challenges to kick this off. I'm really honored to have had the opportunity to be a student to the three of you all as my professors in the data science arena, and welcome Dr. Lars Powell, Dr. Michel Leonard, Scott Williamson to the Investor Forum. So Lars, let me turn it over to you, and Michel and Scott, if you'll unmute yourselves, that'd be great, and we'll get going.
Thanks, Richard. Pleasure to be here, and see if I can share a little bit of my screen like this. Okay, so I put together a couple of slides for this, and let's see if I can, does that look right, or am I sharing the wrong screen?
No, it looks great.
Okay, so asking me to talk for 5 minutes on data science and resilience is like asking to split a hot dog with Joey Chestnut. There's a lot more capacity to talk about these things, and we'd love to talk about them with anybody who's got an interest or resources available. But I wanted to just set the stage with three very different things that I've been either working on or thinking about in terms of data science and loss mitigation. So the picture on the screen is from a company called City Detect. It started, we've got a really smart guy there who knows all about the artificial intelligence classifying pictures. And we put cameras on cars, or we also in Tuscaloosa, we have them on garbage trucks. And we can run an algorithm and see what City Detect does is they see where there's code violations. Well, we got some cameras and put them on another car because we wanted to identify which houses in our most vulnerable areas could be retrofitted to a fortified roof for less than $10,000. We have a state-sponsored program that makes grants for $10,000 to retrofit roofs to the fortified level. And there's some very, depending on when a house was built and under what code, there's some things you can't see from outside the home that keep it from being eligible for this. So we drive this car you see here with, these are just regular GoPro cameras and a souped up GPS device, but we get pictures, street view pictures of all the houses, and then we can run through an algorithm and pick out the ones through artificial intelligence that can be retrofitted to the fortified standard without having to go inside or look in the attic or anything else like that. I think that's a really big step forward. It kind of happened by accident because I have lunch with people who do interesting things, and when we get to talking, we see where it can work in other situations. The next thing we've been doing, wow, that didn't work right. We've been doing a, well, that doesn't show very well. Let me see if I can get out of this and maybe you can see that. We did a cost benefit analysis for the fortified multifamily.
We can see that one.
The fortified multifamily system from IBHS. And using a lot of data science, but a lot of commercial data science, we used the AIR touchstone model to estimate the insurance savings from building apartment buildings in a fortified manner or with resistance to wind technology. We came up with this internal rate of return that is staggeringly high. The lowest one we have is a 9% annual return, whereas the highest, this just depends on where you put it and what you do to the home when you're building it or retrofitting it, goes up to 118% annual return. If anybody doesn't like 118% annual returns, then come see me and bring your checkbook, and you can just keep writing them and I'll keep cashing them. But that's, I think, a real breakthrough using, again, nothing new, kind of commoditized data science at this point, but knowing where to apply it. And the last one is something that's even older, I think. I first saw it maybe 10 years ago, and those are the night view satellites. And I see some heads nodding. A really smart set of people came up with the idea that when you look at the night view satellites, you don't know, say after a hurricane, you don't know how quickly people are rebuilding. And those data would they'd probably be available if you could get everyone's credit card data, or if you could get where their car's gone. But this is a pretty good second best thing. And this is where I think there's real opportunities to be creative and really, really smart in a commercial sense. This was data that we didn't have, things we didn't know. And they said, oh, well, there's satellites that pass over at night. They wrote algorithms that say, here we can see the change from one day to the next and what sort of activity is going on when we can observe it. And from that, they get a measure of how quickly a region bounces back from some sort of disaster. And I think that sort of thing, I'm not saying that data science is a commodity, but I'm saying that there are opportunities to advance that don't require someone who knows all that. You might want to know somebody who knows something about the actual data science, machine learning, artificial intelligence, econometrics, statistics, but to be able to really make a difference in how we move forward here, it's really a matter of finding the information that we don't already have. I know that Scott's doing some great stuff with information we do already have and finding some new information to put with it. I think we need all of this, but if I'm thinking about extending the reach of this, then finding some new ways to get information we don't have, I think is really important. So I'll wrap up there for now and toss it to Scott with RAA.
Well, thank you guys. Thanks everyone. It's a real pleasure to be with you this morning. Just some quick background on what the RAA is. The Reinsurance Association of America. We're really the public policy advocacy organization that represents the global reinsurance industry doing business in the United States. And you can think of really reinsurance as being insurance for insurance companies. We insure the insurance companies and they transfer risk to us, which allows us to diversify substantial catastrophe risk on a global basis, providing for availability and affordability of insurance to policyholders ultimately. What we want to talk to you guys today about, and I think the other speakers, both Lars and Richard, have really put their finger on this, is how we're thinking through using data to help inform where we find an intersection of natural disaster hazard risk, where that is coupled with high social vulnerability and low community resilience. So looking at the intersection of those across a variety of natural disaster hazards and understanding it with some level of depth down at the community level. And so really the struggle that we have is the data exists in a variety of different formats, and it's also maintained and warehoused sort of in siloed areas throughout industry, across different industry sectors. And there's privacy implications to this, being able to get at data that is at the policy level or property level. There's privacy laws that come into play here. There's intellectual property concerns that come into play here, where corporations and businesses invest substantial amounts of money into developing intellectual property around looking at climate change and natural disaster risk and building impacts and impacts to population. But there's really not a common framework for sharing that data in a sort of open sourced way. And it creates difficulties for policymakers and stakeholders to really understand, okay, where are the areas that we should be directing public policy resources, investments in communities? Where is that intersection of most in need, most at risk communities? You may have heard of the Justice 40 initiative. It's an executive order, and part of that executive order is looking at a whole of government approach to really taking the money that's been allocated. And Richard talked about substantial sums of money that have been a part of the bipartisan infrastructure bill, some of the appropriations that have already been made through disaster declarations but haven't been spent yet. And it's really a question of taking that whole of government approach to the funding that's been appropriated or that is available, and setting aside 40% of that to go to socially vulnerable communities. So those communities that are most in need. But what is lacking is really a common framework for understanding how do you measure, what are the rubrics for measuring where we have that social vulnerability, so that the government can actually achieve its goals in a coordinated fashion. So not just the Department of Agriculture or the Housing and Urban Development or FEMA operating independently of each other, but how do we come together under a common measurement framework to understand where we have that intersection of need and risk. So the other challenge is that it's not just the federal government who's thinking through these issues when they're looking forward to infrastructure investments in communities, but so is the corporate community. Corporations are very much dedicated and committed to, you've heard the buzzword ESG, environmental social governance. And there really is a sort of laser focus right now among corporate boardrooms and making sure that we are directing our resources into funding investments and philanthropic giving into areas related to climate change and social justice. And really, if you think about it, this has a nexus back to the Justice 40 initiative. But again, we're sort of left with, okay, what is the common framework for measurement? How do we all get together around sort of the same playbook so that we're coordinating our efforts and leveraging the work that each other is doing? You add another layer of that, it's the philanthropic charitable giving aspect, which is also huge. But again, if there's not a coordinated focus for understanding where we're going to coalesce this funding and financing opportunities and incentives, where we're going to bring the resources to bear, and if there's not a common metric for understanding resilient standards that we're trying to achieve, then we're not really able to act in a coordinated fashion. And so we've been looking at this issue and have really given a lot of attention to FEMA's National Risk Index. And that's one of the things that I want to talk to you about today, because it is where we're seeing an intersection of data. And it's a lot of very granular data with, really millions of data points and inputs across, hundreds of different variables and factors that go into assessing census tract level loss exposure to natural disasters across a spectrum of about 18 different hazards. So think everything from tornadoes, hurricanes, landslides, tsunamis, wildfires, all the things that are contributing to massive amounts of federal spending on a post-disaster basis, right? It really tallies up into the hundreds of billions of dollars over time. And what we're really looking at here is how do we, instead of responding to the emergency after it happens, use a data-driven approach to invest in pre-disaster mitigation so that when the hurricane hits, we don't have a major city like New Orleans being impacted for decades after the event while we try to rebuild something that we could have fortified against disaster and loss in the first place. And so that's really where we're focused. And let me just describe for you a little bit about the National Risk Index. It has really three major scoring components, and they're scored separately for each one of the natural disaster hazards. So one for tornado, one for hurricane, et cetera. But one of the components is loss exposure. But it's not just the traditional metrics of looking at loss exposure, where we look at the aggregated building value, the property value. It's loss exposure that also is looking at population economic loss. And so this takes it away from just a building-centric view to a people-centric view. So in scoring it on a people-centric view, we're sort of leveling the playing field between some of the communities that have been marginalized and left behind in the past because they're too poor to count. They're not high-income communities, and they don't have high property values. And so these communities in the past have been left out. So there's a measure of loss exposure. There's a measure of social vulnerability. So we understand the communities that have more economic challenges, socioeconomic challenges, think things like high unemployment rates that are persistent, low per capita income, maybe a large component of the community is English as a second language. So there's about 29 factors that go into measuring social vulnerability. And then there's about 49 factors that go into measuring community resilience. How prepared is the local municipality, the local government, at dealing with this disaster risk? So we're getting a sort of common measurement framework for scoring communities at that intersection of loss exposure, social vulnerability, and community resilience. And when you put all that together and score and classify every community in America across 18 hazards between those that have very high risk and those that have relatively lower risk, it becomes a measurement basis for prioritizing where we're going to do the disaster infrastructure spending and investments in resilience. And so if you think about it, and what I'm going to try to do here is just share my screen and give you a visual here of what I'm talking about. So bear with me here while I bring this up. So hopefully you guys are able to see this. Is this showing up on your screen? Okay, so what we're looking at here is sort of a visualization of that national risk index. And I'm just going to point out to you the major scoring components. So we're sort of zoomed in here on Maricopa County in the state of Arizona. And I'm visualizing for you wildfire risk. So each one of these circles represents a census tract in Maricopa County. And we're sort of plotting here the expected annual loss on a score basis. So those tracts that have really high expected loss across agriculture, building value, population equivalence value, where we're going to see the most losses on the average annual loss type of basis. And also where we see the communities that have really high social vulnerability. So in a national percentile ranking, you see the ones at the top have super high social vulnerability. So we would be looking for census tracts where you see an intersection of most in need, social vulnerability, most at risk, those that have the highest loss exposure to the peril. And so we're seeing that a couple are scoring really high, either because it's contributed by the y-axis or the x-axis, but you see two that stand out as very high tracts. You can see them mapped over here. And we can also see that there are many that are also in a very high category, not the highest level, but the second highest level. And we can do this for every community in America down to the census tract level. This is all FEMA data that they've developed over a period of years. A lot of the social vulnerability and community resilience metrics are maintained by the University of South Carolina. So what we're seeing is an opportunity to use a data-driven approach, just like I showed you, to understanding that intersection of most in need, most at risk communities. And the idea is that once you've identified them, you would designate these communities, and these would become the places where we would have a sort of concentrated focus across the different funding sectors. So we're talking about federal, state, and local government investments. Again, this is where Justice 40 can come in. We now have a means for identifying where those vulnerable communities are so that we can start a whole of government concentration in a coordinated fashion. Bring in the private sector to leverage every federal dollar of spending. So private sector investments come into play here, and a little bit of incentive through the tax code. And we're talking about some financing vehicles like direct pay bonds. These were incorporated after the financial crisis. They're called Build America bonds to rebuild the US following the financial crisis. Something similar to that could be employed here for resilience bonds. There's also the opportunity to do public-private partnerships and philanthropic partnerships with state and local governments in the form of private activity bonds. So it's really finding incentives to actually bring in the funding that we talked about being available in corporate America through ESG-focused investment and giving across a variety of industries, coupling that with state and local investments and the philanthropic piece, all centered around a common measurement basis for understanding a data-driven approach to the evaluation of most in need, most at risk. So that's really sort of a focal area that we're trying to bring through public policy to actually move the needle and start getting infrastructure projects funded and built so that we can have insurable communities and start making a difference in fortifying our communities throughout the country. So Richard, I've actually spoken a lot, and I want to leave time for discussion and also for Michel's presentation. So Michel, I'm going to pass the torch on to you at this point and look forward to hearing your comments as well.
My pleasure. Thank you so much, Scott. First, three of my favorite people here, starting with Richard. Pretty amazing, Richard, and I mean that from the bottom of my heart. What you've done here with this, it's incredible. The number of people, I understand, the resources under which you work, they are limited, and what you've accomplished here, hats off. By far. So I just want to say that. Lars, when we started this and I got to know you, and we're talking today of resources, pretty amazing what with your help and your contribution Alabama has done in your center. Frankly, early on, I was told it was one of the models in the country. And you know how folks in the North or the Northeast can be on the coast. Come on. But it really is. And I think as we talk today of cost sharing, really what you've done there with the state of Alabama and your colleagues and so forth is an example to follow. And finally, Scott, what I think of your research and what you guys have done at RAA, and a lot of you, what you said today is comparable, but in a more structured way to what we're doing here at the III. So I think, Richard, again, to you, you've put together here a pretty amazing team. And I mean, the two of them and you, not me. And what I would like to focus here is a bit the public communication standpoint. And that's the mission of the III. And I do have a few slides that I will share now. Share a screen. Share.
There we go.
And as you can see, I'm going to put this into the pretty view, which before the holidays, I knew how to do, but you're going to have to put up with the ugly view here because I don't remember how to
There
do
it
it.
is. Yeah, that's
Thank
working.
you. Great. So as you may see, this is something that my colleague and CEO Sean presented in Vegas a couple of weeks ago. I was there presenting on the impact of inflation. Won't bore you with inflation today. Our mission, as I was just saying in the III, is to really take some of the work that Lars, for example, and Scott are doing. Well, actually not as much Scott because you're on the industry side, but really the work Lars is doing and so many folks out there on the technology side, and translate that or bring that to the public. And we've certainly done a lot of that with you, Richard, in terms of some of the technologies you've identified and great opportunities here for folks to invest in. So we're a trusted source of unique data-driven insight, and we try to inform. We have action partners. Some of you may have seen this before. I just want to go through this. And Richard, are you there? Aon, IDHS, Build Strong, FEMA. We have great partnership with FEMA. And somehow, Scott, RAA is not there and the center is not there. I should update that as well. This is a bit of an older slide. My slide has it updated. Sean's version of it is an older one. There we go. Okay, I just wanted to give you some examples here of the technology that we've all been talking about. And this is Miami Beach in 2022 right now, and then 3 inches. Now 3 inches, for those of you, of course, who know what you're talking about, what they're talking about is a lot. But just look at, and the reason I've put this is what the technology taught me in the last few weeks, specifically this image and some of the other things I've been using recently, is that the nature of hardening, which has focused on the coast in the case of flood, has moved inland. As we are doing a great job, quote, quote, at hardening where we know the risk is the most, we're moving the water around. Water flows. That's the point of water. And now we've been communicating about where the risk is, and we're adjusting to this. Now, the other element I want to say with this, and Scott, as quite often you and I think alike, and you talked about adjusting not just for inflation, but also adjusting, did I keep that slide? No, adjusting for population growth and adjusting for GDP growth. So we ran those three, and adjusting for GDP and population gives almost the same result, not surprisingly. But on average, over 10 years, it multiplies by 2.7, so almost 3. And of course, the area that have gotten the most growth tend to be in harm's way. And, we need to think about that. It's not because people want to go there. It's because the land tends to be more affordable. Taxes tend to be more attractive, and so forth. And there are reasons for that. But it's also in harm's way. And that's where it's been growing the most. And that means that the entire country needs to really look at that, because we're all, of course, pooling together to pay for some of this with FEMA, NFIP, and so forth. But 2.7%. So if you take Katrina, which and you double that, you get to a pretty big number. In the industry, we often say our policyholder surplus, which is the money we have that we can use to pay above and beyond commitment. That's quite often where a chunk of extreme weather event losses, fires, wildfires specifically, tornadoes and flood, hurricanes comes from. We always say we speak in terms of Katrina, like 1 or 2 or 3 or 4 Katrina that we can. If we double those, in many cases we're getting a bit above, sometimes even, or dangerously close to our policyholder surplus. And if we look at these trends, which are likely to accelerate, certainly some of the changes in tax policies in the last couple of years, in terms of the repeal of SALT and also in others, will bring more people to leaving the Northeast, likely, potentially, hypothetically, and so forth. We've certainly seen some of those trends already. These are some of the tools that, again, some of you here, my fellow panelists and hosts, you've seen, but I want to mention them. We have been expanding our maps super aggressively, I would say. And this is one specifically for take-up rates for NFIP, for the flood program. And then if you look here, very proud of this, we now have hurricanes tracker, we have our flood exposure. The flood exposure is especially interesting. It goes to how many where is the concentration of homes within 100 feet, 1,000 feet, and so forth. We originally had it in meters, so we had to translate that for folks here in the US. But this is a pretty fantastic tool. It's one of our partners, and it's a pretty unique tool. It's used by underwriters, by carriers, and probably by reinsurers as well. I know that, Scott, you have access to some similar ones, but this is pretty new, because traditionally flood maps do change quite rapidly, not just because of nature, but for a variety of reasons. And they go there. So, go to our microsite for these different tools. No.8, just type in resilience.iii.org and you get to this. So I'm going to stop with these and stop sharing. Just stop sharing. I told you guys, I somehow I took 3 weeks of holidays. I think I should be back. Am I back to just me? What's wrong with me today? The real problem here is that I am using a Mac, and because I'm using, there we go. Because I'm using a Mac, it just, it disappears and everything.
No, that's perfect. Let me, sorry, I just have a few very, very specific points here that I wanted to go into. So speaking kind of the core of the content here and lessons learned, only a couple of minutes, Richard. We do have solutions. The issue is a cost sharing. And you and I, Richard, and all 4 of us discussed that. I'm not really sure anymore there's a solution there in terms of, I've educated myself a lot, 2 years, almost 3 years now into this. And, with the exception of programs like what, Lars, you were talking about, reason to move to Alabama, just put yourself in harm's way, but get that, I think we as consumers need to start looking into this ourselves.
And once the consumers have done it, the insureds have done it with some help from state programs and from carriers in some cases, but carriers, it's a challenge to build the data that we can thereafter go with our regulators and show the benefits. You all don't want us to just say, oh, this will reduce the exposure by 10% and then we can't pay. Then it doesn't help anyone. The modeling is strong, but the way regulators, they want real data. My house here, you've all heard me talk about it. I had a tornado in the Northeast, just north of the city. But there's a lot of technology that's becoming more and more affordable. You've heard me talk about the shut-off valve that a couple of years ago was a few $100s and then a few $100s to install it. You can now have one for $30. We've gone from 300 to 30. 30, it's the price of a meal, maybe for 1 or 2 or 3, depending on your how much you like to spend on this. But it not only will help you for hurricanes and flood, but it will also help you for a small damage in your house, a water leak from a toilet, from a dishwasher, and it will stop that. If you think of a deductible, $1,000, $3,000, $5,000 makes a big difference. So that's kind of where my view on this cost sharing has increased. You now have monitoring services that like ADT and Simply Safe and so forth, not endorsing any. I just happen to have had those over the years. But the add-ons for monitoring of these, let's call them non-burglary, non-theft, used to be $50, $30 per month. That adds up. Now some of them provide them for $10 or $15. And again, the sensors went from a $50 piece to $10 piece. So yes, we do want to get to a point where the industry continues to commit and to have that. But I think we need to, as consumers, also adjust in terms of our willingness and so forth. And then you can negotiate with your carrier. Sometimes there's an opportunity to do that. The last thing I want to say, I joked earlier about the impact of inflation, but it is relevant to us. When we have hurricanes, extreme weather, fires, and so forth, we talk about gouge pricing. And I may be pronouncing it the wrong way here, Canadian accent originally. Thank you, Lars. So once in a while, I wonder if I still have my, So we're seeing the same thing in many ways with inflation right now. If you've done a little work, you've probably experienced it firsthand, which means right now that if we have a flood event, if we have an extreme weather event such as fire, tornadoes, that gouging is going to be double, i.e. supply and demand of workforce and labor, but also in the availability of labor, still not what it used to be. It's going to take at least a year. That almost doubles the time it takes to rebuild. It increases prices before gouging from 30 to 100%. So if you think you have a place where you can your carrier provides you comfortable living accommodations, there's a maximum of days on that, sometimes 30 days, 60 days. Well, we're hearing reports that in all cases now, in very, very many cases, that's actually no longer adequate. That's no longer the same. With cars as well. If you have a repair, they give you a courtesy car for 10 days, let's say. Well, that's very difficult right now to get all the parts and get the labor and so forth. So some of these considerations here, and I think and I'm going to wrap it up on this for the discussion here, but when we talked originally, a year, 2 years, we talked about behavior change. This is the kind of behavior change now we're talking about, not just in terms of big scale, but what can we do right now? And I think thanks to the work of so many different people, supported by the government, by agencies, by academia, and so forth, and trade associations, we're getting to the point where the technology can make a difference.
Right. Let me play off of that point in Lars kind of put a thread to the next 20 minutes of kind of a quick round robin. We never have enough time to walk through all of this. And I actually have a solution that we're working on, Lars, to give a little bit more time to all of this. But I'm going to go kind of backwards, so to speak, and I'm going to talk about technology, entrepreneurs, innovators, inventors, and all. This is a question. I sense that we now have so much incredible data and layers of data that we are actually able to now pinpoint a number of interventions. One question, I sense that if I'm an entrepreneur, innovator, inventor, or an investor, I now really have a way of looking at 4 consequences of the data that you all have just shared. Product development and demonstration. Where do I need to go develop a specific product, and where do I need to demonstrate that product that it'll have the impact? 2, straight up business development and marketing. 3, but most importantly, where do I engage different end users? I sure now see that instead of being an entrepreneur running around with a hammer looking for nails, we now have data that tells us precisely whether it's Lars, a fortified roof, to your point, Michel, about sensors and meters, Scott, to your point about how do we look at large scale project development. Am I saying that right? Am I sensing that, Lars?
So yeah, it's a really big topic, and everything you just said is exactly right, and also incomplete, because it's not one thing or the other. It's all of them. That one thing I was saying at the outset was that data science for resilience is not one thing. It's not, you've got to build the best data science algorithm. You need to find places to deploy it. You need to find things that it will do. There's still a lot of low-hanging fruit, and especially in the public policy arena, that's where we need to be projecting things for this public intervention. But on the private side, the best way that I've found to get in touch with the potential investors is right here on this on this broadcast. Right, this is why we're here, because it's not easy for someone at a university. I mean, universities spend a lot of money and have a lot of resources towards finding investors and markets for their homegrown technologies, but they're very limited, and it generally starts with somewhere they've had success before. So maybe you've got a university with a great pharmacy program or biotech, and so then they know everybody kind of in that biotech area. Or you could have the same thing with resilience, but what you really need is something like this, or like InsurTech Connect, these great meeting places where people can come together and share these ideas, because you have to have structure for that before you can talk about these things. You might have non-disclosures that have to be signed and so on, but having that put together so that the people with the great ideas can get to the people with the checkbooks is, I mean, that is God's work that we're doing here, and hopefully the more we can do it, the more successful it'll be.
God's work against God's work, or with God's work.
But the data, Michel and Scott, to your additional point, the data is becoming more and more precise now. And that ability to target, because I'm going to talk about other forms of resource allocation, but I just want to talk from the perspective of a technology, a piece of equipment, using the data science, as Lars said. Am I right that we're getting, there's a robust set of information now that allows an entrepreneur, an innovator, a non-insurance investor, let's put it that way, to really target where they should be going with their ideas, instead of running around trying to hope like hell somebody's going to listen. Am I saying that right?
Scott, you want to take that one?
Yeah, Richard, I think absolutely. The technology is advancing, whether we're talking about the ability to use satellites and drones for really high resolution mapping and understanding inundation, or where we have fuel for wildfires, looking at property specific data in detail. Lars talked about the GoPro cameras that were on cars. The city I live in has them on garbage trucks as well. I think they're primarily doing code enforcement, but certainly this could be used to look for where you can bring infrastructure resilience right to property specific areas, where we're ripe for communities that might be able to be elevated above the floodplain, or where you might need to do some cleanup around the house with respect to fuel for wildfires, that sort of thing. There's just an endless amount of information that's out there. I think the issues that we're struggling with is putting those pieces together.
Yep.
Because I mentioned before, they are siloed.
Yep.
And some of them in the government wheelhouse, there's privacy issues, some of it in the private sector, there's intellectual property issues. And so it's really getting that cross sharing of data. I think that there's opportunity here for innovation, product development on things that will bring mitigation, infrastructure solutions. And there's also the ability to use a little bit more macro data to understand where you can best target those solutions.
Right.
And then I think finally in the public policy sphere, which is where we're really focused, is how do we communicate to stakeholders and decision makers really in the government process who actually draw the lines and set the boundaries for how the federal allocations are going to be sort of
Right.
doled out, where the investments are going to occur, how we can not just think about federal appropriation of money to these areas, but how we could use that common framework of measurement to also incentivize, through tax credits, through the private activity bonds, public-private partnerships, where we can create sort of hot zones that will incentivize the investment of private sector money, where we could have things that were tax deductions are now tax credits. So a one-for-one write-off, where we can have transferable syndicated tax credits so that we can coalesce the funding to exactly what you're saying, where the data indicates that we have a hazard and a need and a technology solution. We can sort of identify those areas and designate them, prioritize them for the coalescing of funding opportunities. So we're sort of on the back end of the technology into the implementation of solutions is where we're trying to move the ball forward.
If I may, Richard, briefly, for the sake of everyone's time, I think just here in terms of the work we're doing, where, Scott, you spoke very eloquently to, that to the federal level, we're much more concerned, we're concerned in many ways with your clients, the clients of your members, the carriers. A lot of the data modeling is really happening. Used to be true a year or 2 years ago, but now the carriers have caught up. But the data is so much more available on the reinsurance side, and you can aggregate, though NAIC is doing a pretty good job of that now, and there are some tools we're all using. But the state level, I'm just going from on my screen, you're there, and then Lars is here. And we are regulated at the state level. And to your point, Richard, in terms of the data, we have plenty, and Lars said we're still missing some. I'm going to go back to the one we're missing. The ability at the carrier level to go to our regulators with not hypothetical or model data. We don't, I do modeling, as you know, and so forth, and NYU and machine learning, Columbia. Not as well as Scott and Lars, but I try. And that's great, but that's not going to work with regulators, the state level. They don't want that. They want actual, and again, there's a good reason for that. And we're not going to get to this cost sharing. We're not going to get to greater granularity and pricing. We're heading there with cars, telematics, but we're not going to get there. It hasn't started with the IoT for home. Maybe we'll get there, but there are solutions there, but we're not there yet. So that technology, to me, that opportunity for investors to look at ways to bring that kind of granularity that hasn't permeated yet to the carriers are starting to use them, and it hasn't permeated tracking actual data. And that's what we need to see happening so that we get into these situations where we can have the granularity in terms of actual, not created data. So it's going to be my broken record statement today.
I think that all of y'all are saying something that I'll put words in your mouth and then let you correct me accordingly. But I think I've had a conversation with all of y'all about this, that the data now has enough information, excuse me, to identify the delta of the scenarios of the what ifs. We now know what it's costing to not do something, but we now also have additional data that's at least giving us insight about that if we take this action, we can get a 1 to 6 plus 1 to 11 better cost benefit, right? My sense.
But if I may, Richard, just to sorry for that, but we don't. Like, we do not in terms of actual data. I mean, our friend at IBHS, they don't have the actual data. They've done it, the data for, I built something here, I think you all know that, and I use Simpson ties, hurricane ties. That was IBHS. And it was great to say, hey, this is what my industry did, our industry did, but we don't have data. Simpson ties isn't collecting the data about that benefit. We have hypothetical data, but we don't have it. We have stuff that at a portfolio level, Scott can use. But I've been looking for it. So if anyone out there has it, please send it my way, and Lars and I will work on it and we'll distribute it. But we don't have data that show having a hurricane ties improves it this way. The numbers that we have, they're illustrative, but they're not actual. Sorry, Richard, I cut you.
So that goes to my point. I think we're on the cusp. I want to be very optimistic. I think we're on the cusp. I think there's a lot of algorithms doing a lot of interesting pieces here. What I think is really missing are locations for us to pull all this together and demonstrate, do some pilots, not without, I almost want to say all rules are off. I kind of go back to when I was at the Department of Commerce many, many years ago, and I had air.
Yesterday.
When the earthquake hit and knocked down the entire Embarcadero, the bypass, a lot of the financial district of San Francisco. Scott, the federal government did something that we at the Department of Commerce helped lead. And that was, we basically said, we want to get everything back in shape in 45 to 60 days. We're going to look at all the different rules and regs, keep them as intact, but what we are not going to do is put the burden on. And if anything, we're going to incentivize all of the developers, all the construction, all this, all right. I think
that's a great example, Richard. That's a great example of where the data is missing. You know this better than me. Salesforce, the tower, a few blocks from there, is sinking. And that's in an area where the Japanese have done, decades and decades of work. We have a lot of data and actual buildings, but even there, the data is incomplete.
But I think what we're missing, if I'm sensing it right, is I'd love for us to find 12 to 15 locations around the country, take the data that's on the table right now with some algorithms, with some take the technologies, take the equipment. I kind of also go back to something that we're having a conversation with a number of county judges now, who are saying, Richard, what do we have to do to create incentives and credit pools for, kind of community-based risk sharing, cost sharing, risk transfer, right? All of this is wonderful. It's kind of like having all the tools in the toolkit, but not having a way or a place to actually go use them to the greatest benefit. Am I crazy for that idea?
I think you're right on. I think you're right on target, Richard. That's what we need to do, and I think you're right. Sometimes it's easier to implement solutions in stages and starting with pilots in areas where you can identify that you have that exposure. Number one, and that's the easier part, the identification of the exposure.
Yep.
Then bringing to bear the technology solutions, right, that we have been developing that will mitigate that particular vulnerability in that community that's been identified. Do that on a project basis. And in doing some of these pilots, we can start to collect over time some of that cost benefit actual scoring information that, as Michel was talking about, can be the feedback loop into insurance pricing. So instead of looking at things just from a historical loss cost perspective, we know what happens when the hurricane hits and you don't have ties versus when we didn't collect the data to begin with. And now we can start understanding what the cost is of a roof that blows off versus one that stays on. And that can be, that infrastructure resilience improvement can actually come back into the form of a benefit to consumers because they'll have reduced insurance costs. So it's really about many things, but it's reducing the risk overall that's going to increase availability and affordability of insurance. And that's all about insurable communities. And that really should be the goal here.
And I sense to the three of y'all that what we're also looking for is immediate ways to build confidence, right? Whether I'm an elected official or I'm an investor, all right? And I'm not just talking about the insurance side of the investment community. I'm talking about, the traditional, pieces to it. Let me ask one other question, and then I know we're going to run out of time. We probably should have scheduled Lars. And what we may do is come back and do version 0.2 on this, all right? How do you all sense the non-insurance investing arena stepping in? And I'm talking about, let's just talk about the large financial houses, the all the way over to family offices, other, social impact investing, all right? Is that a part of how we now use this data science to bring them also to the table?
Wow, that's so. When I think about different pots of money, I think about them all, with one exception, chasing the same thing, and that's a return. So the government does not have to chase a return. The private sector does and should, because it's their money, whereas the government's money is really our money. I think that our job in the analysis sector is to say, here are the things that are worth investing in. And from the federal government standpoint, or even state government standpoint, there's slightly different. You still don't want to see things wasted. You don't want to see dollars wasted. You want to see people's time wasted. But the idea that you can have government fill this role that private sector shouldn't fill is, I think, a really good one. And we're seeing that today. We're seeing a lot of resources being allocated. The difficulty is trying to, if you've ever filled out a FEMA grant, like one of the community block grant things, it's an unabridged process. It's very opaque. You don't know who's what. I mean, there's a list of, there's a rubric, but there's also a lot of kind of reading the tea leaves that goes into figuring out whether or not your application has any chance of success. That depends on relationships and a lot of experience, and is still wrong most of the time. So putting some, getting rid of some of that opacity, making it clearer where that money's going to go and how you can get it without having to pay some engineering consultant $100,000 to fill out the application for you, I think is something that's very low hanging fruit for the federal government. Now, I'm not saying it's easy to get FEMA to change. I am saying that it's possible, and it should be easy, at least in my mind.
So let me share a couple of quick observations, because I think, again, a couple of the takeaways. I always like this to be a call to action, and I do think that there is one, but something, Lars, that you just said, chasing the returns, all right? Everybody has a focus on returns, and we're talking, I think, about 4 sectors: government, private sector investors, insurance, and philanthropic. And I'm finding that the philanthropic may actually be an interesting form of the glue that may bring some of this together, because their version of returns, they still want to have a social impact, and they actually would like to have a return. They're not just throwing, certain ones are throwing money over the transom. So,
Richard, if I may just interject here, because I think you'll find this interesting. God, I think hopefully it wasn't 30 years ago, it was 20 years ago, but I think it might have been 25. My former CEO at the time and a colleague started ethical investing. And it was early on, even the term wasn't there, and it became the kind of ESG and environmental, and so forth. And I frankly was like, what are they doing? Didn't even understand. They were visionaries, and more than me in that case. But the way they first did it is to go to the pension funds of churches around the world.
Right.
So the Shinto church, which manages humongous forest actually nationwide for the rebuilding of temples, which have to be. So, we have insurance itself, I would suggest, is already a form of ESG, because we do tend to be and so forth. So, but I so much agree with you but again, we don't have the track record for this kind. They were willing to take a little less, but not that much less, because they had to be there and provide pension, to their members and their former employees. But today they've demonstrated ESG, et cetera, has demonstrated superior returns.
Right.
We want to get there. So I think your approach there is extremely powerful, but I wanted to give a practical example for our viewers and you.
Right. Well, listen, I greatly appreciate y'all's time, your partnership, your collaboration. I'm actually going to propose, Lars, that I want to do one more session, and I want to come back and talk about Risk 2.0, just to see if we can really spark the market a little bit on some of that. But also what I'd like to do is maybe convene us with one or two other folks around this idea of a pilot or project type of definition, Lars, where we're bringing the technology, the equipment, data science, and these different forms of capital together. Because I think we're now at a point, based on the conversations that we've had in the forum, where there's some pretty smart minds that we've been able to assemble here. So I want to thank Lars for your leadership in Alabama and across the country, and continue to play a role with us on helping move this data exchange idea. Michel, always for your presence and support, and Scott, thank you so much for all the leadership that RAA is doing. It's phenomenal. I look forward to us continuing to find a way to move the needle really forward in all of this, and to ultimately drive home that we have an opportunity to really make a change in 2022. I remain optimistic that there is enough of a demand for what we're trying to get done. It's just a question of how, and with smart brains like this, that makes it a lot easier to move things forward. So thank you all for your time and effort. We look forward to reconnecting very soon.
Thank you, y'all. Thank you, Lars.
Thanks, Richard.
Thanks, everyone.